As of this moment, shares of Nuburu Inc., trading under the ticker BURU, are priced at 41 cents, marking a catastrophic intraday plunge of 19.92%. Now, seeing a nearly 20% drop in a single session on a sub-dollar stock might lead many to a simple conclusion. It's just another volatile penny stock doing what penny stocks do. The expectation is that this is a company facing some minor setback, a missed earnings report, or perhaps getting caught in a broader market downdraft. But the reality of what's happening with Niburu is far more severe and structural than a single bad trading day. This isn't a dip, it's a distress signal. The drop we are witnessing is the market's brutal response to the company's existential struggle against being delisted from the NYSE American exchange, a battle it appears to be losing spectacularly despite recent desperate measures. The common belief among those who still hold on to hope for Niburu is centered on its technology. The narrative is that its high-power blue laser technology is a superior tool for welding and 3D printing, especially with reflective metals like copper, which are critical for electric vehicle batteries and advanced electronics. This technological edge is supposed to be its golden ticket. Investors bought into the idea that this unique capability would inevitably lead to massive contracts and a soaring valuation. The problem is, the market has stopped pricing in that distant potential and is now exclusively focused on the company's immediate and dire financial and regulatory predicament. The expectation of technological dominance is being crushed by the reality of corporate survival. While many investors are looking for the next NVIDIA stock in the tech space, the risks here are of a completely different magnitude. This isn't about capturing a new market, it's about staying on the board. Let's dissect the recent price action because it tells the entire story. The stock has been in a perilous downward spiral for months, primarily driven by its failure to meet the NYSE's minimum bid price requirement of $1 per share. In a bid to solve this, the company executed a 1-for-40 reverse stock split just a few weeks ago. This is a classic financial engineering move designed to artificially boost the share price back over the compliance threshold. For a brief moment, it worked on paper. The stock price jumped, but the market capitalization remained the same. However, such moves are often seen by seasoned investors as a sign of deep-seated weakness, not strength. Instead of stabilizing the stock, the reverse split seems to have simply reset the starting point for a new leg down. The price has bled out consistently since the split, and today's 20% collapse is an acceleration of that trend, signaling that investor confidence has completely evaporated. The volume accompanying this drop is significant, suggesting that this isn't just retail traders on the Robinhood app getting shaken out. It points towards a broader capitulation. The core of the issue is the official notice of non-compliance from the NYSE. Niburu was given a cure period to regain compliance, and the reverse split was its primary weapon. With the stock now trading near 40 cents, that attempt has been an abject failure. The company is now staring down the very real possibility of being delisted, which would banish it to the over-the-counter markets. For any company, this is a devastating blow. It dramatically reduces liquidity, scares away institutional investors who are often prohibited from holding OTC securities, and makes it incredibly difficult to raise fresh capital. For a cash-burning company like Niburu, the inability to raise capital is a potential death sentence. Anyone managing their portfolio through SoFi Invest or Fidelity knows that a delisting event is one of the biggest red flags a company can have. This isn't the sort of calculated risk you see with a blue chip like Tesla stock. It's a binary bet on survival itself. What does Niburu actually do? The company designs and manufactures high-power industrial blue lasers. This is a legitimate and interesting technological niche. Traditional infrared lasers struggle with processing materials like copper and gold because these metals are highly reflective at those wavelengths. Niburu's blue laser, operating at a different wavelength, is absorbed much more efficiently, allowing for faster, higher-quality welds and prints. The primary target markets are e-mobility for welding battery components, automotive manufacturing, and consumer electronics. The technology is sound, and the industrial applications are real. However, having a great product is only half the battle. The other half is commercializing it at scale, managing finances prudently, and building a sustainable business. And that is where the company has fallen short. Their financial statements paint a picture of high research and development costs, significant cash burn, and revenue streams that are not yet large enough to offset the expenses. In a zero-interest rate environment, investors were happy to fund promising but unprofitable tech. In today's higher-rate world, the market's patience for such business models has worn thin. The path to profitability looks too long and too uncertain. Looking ahead, the future for Niburu is fraught with risk. The most immediate and significant hurdle is the NYSE delisting threat. Can they avoid it? It seems highly unlikely without another even more aggressive reverse stock split, which would likely alienate any remaining shareholders. A second major risk is their cash position. The company will need to raise more funds to continue operations, but doing so will be incredibly difficult and highly dilutive to existing shareholders, given the current stock price. An equity offering at these levels would be devastating. This is why many prefer managed online investing options like Schwab Intelligent Portfolios, as they are structured to avoid these single-stock blow-up risks. The potential catalysts, on the other hand, are few and far between. A surprise announcement of a major transformative contract with a leading automotive or battery manufacturer could provide a temporary lifeline and a massive short-term price spike. A strategic investment from a larger industrial player could also change the narrative overnight. But these are low-probability events. The most likely scenario is a continued struggle, a fight to secure financing, and a high probability of ending up on the OTC markets. Platforms like Interactive Brokers, known for serving sophisticated traders, provide the tools to trade such volatile instruments, but the risks are extreme. Comment below if you believe Niburu can secure a major partnership in time to save its NYSE listing. In conclusion, the story of Niburu is a stark lesson in the difference between a promising technology and a viable public company. The expectation was that its innovative blue laser would disrupt the industrial manufacturing space, creating immense value. The hard reality is that the company is buckling under financial pressure and regulatory scrutiny. The 20% collapse today is not an isolated event. It is the market's verdict on the company's failing attempt to cure its non-compliance, and a reflection of profound doubt about its ability to survive in its current form. The focus has shifted entirely from its technological potential to its financial fragility. For investors, the question is no longer about how high the stock can go, but whether it will have a major exchange to trade on at all in the coming months. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Please like, comment, and share this video to support the channel. Heart button.